safety, business owners' mindset, and convertible bonds. First and foremost, margin of safety is very important because not losing is the surest way to get rich. If you lose money, if you get in at the wrong time, if you pay too much, then that's probably really bad for you. Too high of a price can lead to almost 10 to 15 years to even break even with the index. So, very important for you to have a good margin of safety for the decisions that you make. By refusing to pay too much for the investment, you're minimizing your chance that your wealth will disappear suddenly. The risk is not in the stocks, it's in ourselves. So it's very important to have huge margin of safety and see what would happen if I'm wrong. Ask that question. How much can I lose? What's my absolute downside? Do I have the risk tolerance to bear that downside? Typically in stock markets, you need to have at least 50% capability if you're trying to invest in index funds. Companies have gone down to almost 99% to bankruptcy. So very important for you to have the right risk tolerance. Do I have the track record of better similar decisions in the past? When I pick a stock, I need to probably do some homework, maybe track the company for a year, do some transactions just in my Yahoo Finance portfolio, not actually doing any transactions, just following the company, and then see how you do. If you did better than the index, maybe you have a chance. But if not, why? Why even think about this? Check others. Is their performance better than yours? Then why are you investing and not giving them the money to invest? Do I know something special that others don't? Very rare, but if you do, that's what you're going to get rewarded. My trading costs, tax implications, all something that I have to think through. Am I relying on my willpower or my strong habits because I have strong investment policy document that I follow regularly? So willpower is very tricky to use in the situations. You can get highly emotional, you can burn yourself down to losses that are not tolerable. Have a strong plan for dealing when things get wrong. Do you have one? If not, you should probably diversify and have a very strong foundation of index funds before you pick any of these regular stocks. Remember, risk is the probability of being right plus 10 times the consequence of being wrong. So if you're wrong, then that's a bigger problem, much more heavily weighted. So that's margin of safety. Very critical in making the final call. Make sure you don't pay too high of a price and make sure you don't get in at the same time where everything maybe could be at the peak. It's very hard to predict. Second, having the business owner's mindset. When you buy a company stock, you are a business owner. You become a business owner because you are part of that, you own part of that business. That means all of the managers and the CEO actually work for you, work for your investment. And so you have to have that mindset. Intelligent owners would keep this mindset and influence decisions of the board, influence decisions of what kind of dividend policy exists, influence decision on payment to top executives by voting. Read proxy statements carefully. You can vote on decisions. You can request for audit firms that are independent, that are better. And be willing to work hard because now you're a business owner. You have to get your voices heard. If you feel something's wrong, some directors are not doing the right job, attend annual meetings, dial into conference calls, ask questions, speak up for your rights, rally other investors, join your cause. Business owners' mindset is not an easy thing. But if you see executives which have this mindset of daddy knows best, like, hey, we were not going to pay dividends because we're going to use it for expansion, most likely though that money will be piled up, not really used, or if used for a lot of wasted and insanely expensive mergers and acquisitions. So make sure that dividends are being paid. High dividends are linked to profitability and future earnings because they're highly correlated. And dividend increase is also a very good sign. So that's an important thing to keep an eye on. And finally, share buybacks. Check if your company is buying shares at the high and selling at low, because there are options that are expiring and people are going to convert options in stock and going to reduce the earnings per share. So check what number of options are being converted, when the share buybacks happen, and if it happens at the right price. So it's very important, because if company pays a dividend, then the volatility of the stock is dampened, and certain options are used judicially. And sometimes even reporting and accounting for tax purposes, certain options are considered, but for income statement, not as expense. There's a lot of accounting things that you need to also get better at, and think about it from a business owner. So having this mindset of a business owner is the next most important skill. Convertible bonds, very briefly, for a defensive investor, covering your downside is never worth surrendering most of your upside. You're paying a lot of fees by getting into convertible bonds. It's not worth it. Unless you have like a lot of money and you want to invest a lot of more than $100,000 into this. Remember, in Wall Street, cuteness and complexity goes hand in hand. So it's quite simply, for me, it feels like reading the book. Probably avoid convertible bonds. Look out for non-transparent transactions that a company does. These are some of the tips. If they buy a pretty big company and report it as goodwill, but eventually there's no real goodwill that manifests because there's no customers, then there are wrong purchases. It should be reported as an expense. Acquiring companies on a spree because to increase the revenue, it's also not a great idea. Check for balance of value being created within the company versus just acquisitions. Buying smaller companies that are way smaller than the current size and the split ratios, check for that. High prices being paid for really bad acquisitions, another important thing to check for. And basic misses in accounting, like Toys R Us and eToys in 1999. Toys R Us was much bigger, much more stable, much more in asset size, but eToys was much more expensive. So it was insane. Anyone would have failed basic algebra comparing some of their balance sheets. So check, compare and contrast. Avoid convertible bonds. Another useful points: every company at some point in time trades at a bargain price. Why? When everyone panics, the entire stock market goes down, then a lot of mutual funds are under selling pressure. When that happens, even the good companies' shares are sold. So that's the time when you can get at a bargain price. So compare and contrast one industry with the other industry. Sometimes you might be in an industry that's been running on full steam, so you might want to get out of it and get into something boring but much more stabler. So companies that get added to the index also gets a huge demand boost, and that's where the supply is low, the price goes up. Another thing, I can name a stock that's much more pricier than X, so X must be cheap. No, that's a pretty bad way. If the stock is falling more than the market overall, that means it has much more risk associated. Check the holding of the parent company during mergers and acquisitions, the split ratios. Very critical when mergers happen, especially if it is stock-based. The stock market going down causes even the good companies' stocks to go down, as we said. That's the time to buy. Don't buy a stock just because its price keeps going up. Check if the value is also equally going up. Compare and contrast. Might want to move out into completely different industry or a company. Again, the stock market only rewards you if you have a strong vision and if you have the courage. So based on everything that I've read, there's a lot of useful things that we've learned over the last 15 videos. Many of Benjamin Graham's disciples are very successful, so it's no chance that they're using some of these skills. My gut tells me, reading all of this book, this requires a lot of work, and your survivorship in this is every year going to be, the odds of your survivorship goes down every year when you're picking stock. So you better pay a lot of time and attention, have the courage, have the vision, have the habit, and have the mindset. Only then can you win. So good luck and happy investing.